Alrighty, guys, welcome to another episode of the WealthWise Show. I'm your host, the Wise Investor, and today we're going to embark on a WealthWise journey in personal finance. So join me today as we embark on this, hopefully WealthWise journey, and get a couple of housekeeping things out of the way. For starters, understand that this podcast, this episode, and anything I say, any companies I mention are my opinions only, and not to be taken as personal financial advice. This is for educational purposes only and does not reflect the opinions or views of Simplicity Wealth or anybody who I'm attached to. And there's something else. That was another part of that disclosure. I'll be in the description. So understand, guys, yes, educational purpose only. Please do not use podcasts or this episode or use me in this format as your advisor. Please consult your financial advisors. If I'm your financial advisor, still consult me. And with that being said, let's get on with today's episode. And so today is Thursday, the 15th of February. So a day before this video comes out that you're watching it. And we had, I think it was the retail report. And this week we also had CPI. And then tomorrow on Friday, we have PPI. So I'm pretty sure you guys remember a couple episodes ago, I talked about the different reports and why they're important and things like that. And once again, CPI came out this week, and it was a little higher than normal. Well, we shouldn't say a little higher than normal, but it was higher than expected. That's the right way to work that. So with that being said, since it is higher than was expected, the market did sell off. And what does that mean for you? What does that mean for me? What does that mean for anything? Well, the reason why it's sold off because it was a little bit higher, and that gives, the markets, people who are the different investors in these different companies and things like that, they give them a hint of what may happen in March and what may happen in May. March and May are not usually, they are the decisions on whether the Fed is going to cut rates, are they going to keep rates the same, or are they going to raise rates? So the interest rate decision is happening then. And so when the same economic data comes out, usually people on Wall Street and different investors, they take that data and they try to synthesize it so they can, understand what the Fed may do. So that's why when those type of reports come out, it reacts that way. Like I said before, the markets are a leading indicator. So like the S&P 500 and all that stuff are leading indicators, and they're trying to do a lot of guessing work. And so, is it something that's, I know in January for the month of December, it came in a little hot. Does that mean that this is a current trend? Well, not necessarily, because even though it came in hot last month and it came in hot this month, it still went down some. Now, it just wasn't as what people was expecting. It still was pretty high month over month, but doesn't mean, if it was higher than last month, then that'll be an issue. So just because it didn't align with what, people were expecting doesn't necessarily mean that, everything is gone away. All the hard work that the Feds did is, has been undone, and, gone into a great recession. I don't think that's the case, but who am I? I'm just a guy on the internet. I could be totally wrong, which I have been wrong plenty of times, and will be wrong plenty of times in the future. But when you're looking at these type of reports, if you are someone who's not day trading, if you're not someone who, you're not using these reports to capitalize on the movement of the markets, just take them with a grain of salt and, talk to your advisors. If I'm your advisor, talk to me. We have game plans in place for things like this. At least, they should. And, making sure that, your comfortability in the markets is utmost important. So if you're not comfortable with what's going on, talk to your advisor. Maybe they can talk you off the ledge. But at the end of the day, it is your money. You can do whatever you want with it. So that's the general report for this week. I'm still in the camp of, rate cuts at the end of the year. I don't know. Let's see. Maybe. It could be. Might not. Who knows? And in all honesty, is it really that big of a deal in the grand scheme of things? If I've been invested in the market for over 30 years, does it really matter? If I have 30 years of price action and appreciation, it all depends on when you got in. If you got in this year, okay, yeah, I'll be more cautious. But if you got in 2020, it's 4 years of price action, higher than you were when you got in, more likely. So that being said, wanted to finish up the options conversation we had last week, talking about the different contracts that options are, the calls and the puts, and explaining, blah, blah, blah. You heard last week, so I don't need to recap. And this week, I wanted to talk about the different strategies of how you can use options in your portfolios, and not in the sense that a lot of people may mention. Like if you look up options on YouTube, they're talking about, get rich, be an options trader and all that stuff. In reality, I want to talk about the way options were created, why they were created, what they're meant for, those type of strategies. Because the strategies where you're using, high risk scenarios are using high leverage and using high risk assets like a naked option. That's not really something that I teach on this particular channel or in this particular medium. It is something that if you're interested, like if you looked at, you never saw me before, this is your first time seeing me, hello, thank you for joining, thank you for the view, and you're saying, he's talking about options, I'm going to get rich. Probably not with me. I'm more the capital preservation type of person. I'm like, hey, let's keep the money we make and let's try to grow it in a safe manner. So that being said, one of the strategies that a lot of people in the industry use when it comes down to gaining some income, maybe even protecting their appreciation. If the stocks, like right now, we're at all-time highs. We're near all-time highs. We're not at, I don't know, I haven't checked the market yet. But we're near all-time highs. I'm not saying we're at all-time highs, because we could be. I don't know. Point is, we're high. And the market is, if you look at the RSI, if you look at the, just in general, everything seems to be really, I don't want to say overvalued, overpriced, but pretty expensive. So if I was in the market and I want to protect, the appreciation that I got from November to now, what would I do? So one of the strategies that I will implement is selling calls. I'm not sure if I talked about it. Probably talked about it in my head. I'm not gonna lie to you guys. I make these shows and I listen to these shows 100 times when I'm editing and all that stuff. So I don't go back and listen, but I'm pretty sure I might have talked about cover call options, like maybe 2 or 3 episodes ago. But that is a great strategy when you're thinking about, hey, we're high, the market is going to be coming down. I can make some income. And so, if you are in the camp of, hey, if my appreciation goes down, I won't be able to, do X, Y, and Z. So if you have 100 shares, I'm pretty sure, actually, I remember this episode. It was very confusing. But hopefully I can explain it a little bit better than I did last time. So let's say you have 100 shares of a company or an index, ETF, and you understand that, hey, we're at all-time highs or we're near all-time highs. Well, you can simply write call options, write your call options and sell them to somebody. Typically your broker will do all that for you. So it's not like, you got to go find a seller. And what that allows for you to do is, if the market goes down, let's say, you have something for $100, you have a stock or something like that for $100. Sorry, I had to burp. You have a stock for that's $100, and you're like, you know what? I bought it at $25, and now it's at $100. I think in the next few months is going to be maybe go back down to $50. I don't know. That's a pretty large drawdown, but I don't know. Well, you can sell a call option. And when you sell a call option, you're basically, like I said before, when you sell a call option, you're giving someone the right, not the obligation, but you're giving them the right to purchase your shares at $100 or wherever the price is at, a month from now. So you say, I want to sell the March 15th, 2024 call option for $100 for this underlying stock. And, I'm going to get $200 in premium from it. So when you sell that option, like I said, your broker does all that stuff for you. So it's not like, you just decide the strike price, which is the price that you want to sell at. You decide the exit or the maturity date or the expiration date, which is going to be, March 15th. And then, you can even decide how much premium you want to get off of that call option. But 9 out of 10 times, depending on your, the markets and all that stuff, the broker is going to suggest a premium. And then, you can do your premium. And then once you, give your broker all that information, which is their interface should be pretty simple to do. They take that, they go find a buyer, boom, there you go. It takes microseconds. But yeah, if it's a high and you feel like the market is going to come down and you want to collect $200, collect your $200. And if March 15th, it was not over $100, you was right. It went down to $50. You get to keep your $100 or your $200, and you get to keep your shares. The flip side of that is, let's say yours wrong and it goes up $150. Now you still get to keep the $200, but now you have to sell your shares for $100. And depending on the situation, you can, hey, it's never going to get to $300. And so you're going to get less premium because the likelihood of that happening is low. But, you can still collect income. So if you're getting $20 a week off of selling contracts, off of your 100 shares, you can do that. So cover called option strategies are a great way to participate in the option market without having huge amounts of risk. And the flip side of that is cash secure puts. So remember what a put is. So if you were to write a put contract, you're giving someone the obligation, or you're giving someone the right, not obligation, you're giving someone the right to sell you their shares for X amount of dollars. So call options, when you write those, you give someone the right to buy them. When you write a put option, you're giving someone the right to sell them. So you can potentially purchase shares at a lower, or not lower price, typically at a higher price. But let's say you want some shares. One of the strategies that I used to implement for myself personally is, hey man, for example, this is, I'm no longer in this company. I don't have any shares in them, full disclosure. But AMD was a company that I was invested in last year. And, they're a great company. And I wanted to purchase some shares. Now, it was around, I think, like the $75 mark. And I was like, you know what? I'm going to, I have the cash. I'm going to sell some puts. Because, I have the cash for the shares, but, I was a little, kind of like, do I really want to, do this now? So I got sold some shares or sold some puts, got the premium. It did go down. I think it went down to like $60, $65 or something like that. And the person who bought the contract exercised, and I got, I paid for those shares at $75 or $70. No, I think it was $75. It was a while ago. Anywhere 70, 75, around there. And yeah, bought them for, it sucked for a minute because, I had to buy at a higher price when I could easily just went and bought them at a lower price. But I got the premium, and I put that premium into, some more shares at the lower price. And, it worked out. It went up to, I think, $80, $90. I think I sold at $90 or something like that. And if you look at AMD now, that was a terrible idea, but at the time it was a trade. It wasn't something that, I was holding on to. But that's just an example of how you can utilize cash secure puts to buy shares, and you get extra cash on top of that. Like, it sucks in the, if I knew, AMD was going to get to this height, that's a bargain, buying at 75 and still getting premium. Now, it'd be even a better bargain at 65, but, it is what it is. So, that's pretty much how cash secure puts and cover call options are how they work. So those are some of the, safer, I would say, naked call options, naked puts, things like that is a little more riskier. That is when you, let's say you don't have the shares, of a company and you sell a call and you don't have the shares. That can be really dangerous. So back to my show notes, because I'm getting off script a little bit. I'm not gonna lie to you. That's pretty much it. The next topic is talking about the Greeks. I don't know why I put that in there. The Greeks are boring. They do matter. The Greeks are a component of contracts, and it's something that I'm probably going to say look up on your own time, only because they can get pretty detailed. And if I don't want this episode to be 3 hours long, I'm just going to give you some highlights of what the Greeks are. So like I said, the Greeks are a metric of option contracts. They are different components of an option contract that measures different things, and they tell you how much an option contract is going to be worth, how much a contract is, how much money the option contract is going to lose over time, etc. So you have the delta, the theta, the gamma, the vega, the rho, and things like that. So just a brief explanation of them, because I'm already at 18 minutes. Delta, which is delta and theta, are going to be, I'll probably say, the most important. And maybe, some people might argue, but I think the delta and theta, especially theta, is really extremely important when it comes down to buying option contracts. When you're selling the contracts, those are kind of important, but depending on what you're doing it for, not really. But if you're buying option contracts, so let's say you're buying calls, so you can purchase shares at a later date at a lower price. So if you want to do the opposite of the cash secure puts, and you say, hey, I want to buy some in the money calls to XYZ. I want to buy some in the money calls. And in the money calls, which I've already explained, is when the strike price is lower than the current share price when it comes down to call options. And you can use that to buy shares. It gives you the right, not the obligation. But delta defines how the price of the contract. So remember I said premium is how much the contract is, how much you'll pay for the contract, or if you're writing the contract, how much you're going to get for the contract. Well, delta defines that pretty much. It defines that premium because it uses the underlying asset, which is stock or index ETF. So let's say it's $100 for the stock is at $100 and the delta is 0.4. So that's $40. So for every dollar that the stock moves, you're going to make $40 essentially. That's a very crude explanation. So don't think that's that's just trying to, for example's sake of how that works. But theta, on the other hand, it measures, how much how much the contract will lose in value at a rate of time and price. So the theta is the rate of change between the option price and time. So one of the things that I haven't mentioned yet, which is I'm glad I am talking about the Greeks, because theta, as time gets closer to the expiration, let's say you have a contract that expires next week, every day that you hold that contract up until expiration, the value of that contract is going to go down every day. And theta, will determine how much, that contract will go down. And so theta, that's why I said theta and delta is important, because theta tells you, okay, well, how much time decay, how much time is going to decay the price of my contract, and also delta is going to determine how much money I'm going to make or lose, depending on if the market is going up or down. So those are, to me, the two important, but just some honorable mentions. You have gamma, it's the rate of change between the option delta and the asset price. Vega is the sensitivity to implied volatility. Implied volatility, I'm pretty sure I haven't explained. Actually, I might do that, because that is one of the big indexes, the VIX. So volatility in the markets is when when the markets move extremely fast, whether it's up or down. Well, if you look at a index called the VIX, which is, volatility, which measures how volatile the market is. Gamma actually, measures that, I guess. Yeah, it measures the sensitivity to implied volatility. So let's say earnings is happening, and your company had great earnings and you bought some call options the day before. Super risky. I'm not suggesting to do that, but I am saying, using this for example, say educational purposes. And so the applied volatility is going to be pretty high because of how much volume that stock is going to get. Now, volume is pretty much how much money is going into that particular stock, how much money the investors are pumping into that stock at a fast rate. So if I'm an investor in X company, or when I say X, I don't mean a company, I'm just using a, X, Y, and Z, it doesn't mean anything. It's not a real company, but let's say X, Y, and Z company had really good earnings, and me and 100 other investors all decides to put in, $100 million into that company. That's a lot of money going into that company at one time. And, that's going to move the price pretty drastically. And that's where volatility comes in. And so gamma is, I would say, is also probably important too. Not gamma, vega. Vega is also kind of important too. Because that will determine, pretty much how fast, this money coming in, and that could determine a lot when it comes down to your delta. I pretty much covered a lot of this stuff. I'm going to go back to making episodes, more than one episode at a time. That way I can have time to look over things, study things. I tried this whole, let me do it the week of. It's not really working out for me. But if you guys want to know more about options, if you guys want to learn more about the terminologies that I mentioned, if I sound confusing, a great asset that I recommend to a lot of people is Investopedia. They're not a sponsor. They're not someone I have a relationship with. They're their own thing, but they have a lock on educational or finance education. Yeah, they have a lock on finance education. So they are a great tool to utilize when it comes down to, not just hearing what I'm saying, but if you're just listening casually, that's great. But if you're actually like, hey man, I want to know what this means, Investopedia.com. And go to Investopedia, type in options, and they'll tell you the definition in full detail of the Greeks, call strategies, put strategies, what are the definitions, what are derivatives, what is in the money, at the money, out the money. In the money is that means that the price of the option is above or higher than the strike price, if it depends on the put or call. Out the money is, the opposite. At the money is, the strike price is at the, where the share price is. So pretty simple stuff. Try not to overcomplicate it, like I be doing. And I be doing is not a real way to say that, but I did it anyways. But anywho, I'm rambling, and I gotta get back to work. So I appreciate you guys listening to this episode. Next week, I don't know what I'm going to talk about, but it's going to be something, hopefully. And tune back in to see. It's a mystery. Might be something you just needed to hear. Hopefully. So I appreciate you guys. Thank you for joining me on another episode of the WealthWise Show. I've been your host, the Wise Investor. And until next time, guys, stay WealthWise.